Hello everyone, and welcome to our market alert video for today, which is July 18, 2025. As usual, I hope this video finds you healthy, wealthy, and wise. I am Ken Moraif. I'm the founder and CEO of Retirement Planners of America, and we have a singular goal, and that is to create as many squippers as we possibly can. And I'll explain that in just a minute. But before that, let me tell you, this week we're going to talk about two very important numbers that came out. One was the inflation numbers, the CPI, and of course, the most important number, which drives our economy in our view, and that is consumer spending. So we're going to talk about both of those. And so let me explain SCWPS to you if you don't know what that means. SCWPS is the acronym for Second Childhood Without Parental Supervision. That's what we call clients of ours when they retire. We want them to go play, have fun, enjoy, and don't worry about all this boring financial stuff. Let us do it for you so that you don't have to. And so that's what we're about. So let's dive into the weekly market action and what happened. So of course, CPI came out, the Consumer Price Index, and it went up. So on the surface, it appears that inflation went up, which is bad news. However, if you peel back the onion and you look inside at the core inflation number, what you find is that it actually went down. And that's why it was well received by the markets. And because inflation going down means that the consumer's prices are still affordable and the consumer continues to spend. And then that leads us into the consumer spending numbers, which we got, which surprised almost everyone. And the consumer actually is spending more. So what that tells us is the economy appears to be healthy. The consumer is resilient and healthy. And that bodes well for our investments, both on the stock and the bond side. So what we have now is several other issues that this applies or apply to this. One is tariffs. The other is the Federal Reserve, and are they going to lower interest rates or not? And then, of course, the third is the big gorilla in the room, which we're going to watch very, very with great interest, and that is we have 1/4 of our entire debt, $9 trillion of our debt is coming due for a refinance here in the next 2, 3, 4 months. And how well that goes is going to have a great deal of the impact, we think, on the market. So let's talk about tariffs first. First of all, I want to thank you guys because I found out that we had our 1 millionth, yes, I did say million, 1 millionth view of our podcasts and our weekly market alert videos. So I want to thank you guys so much for that. And I want to encourage you, if you haven't seen the podcast on tariffs, that you do. And so I'm going to ask my team to put a link here somewhere so that you can watch it. If you don't know where it is, go to our YouTube channel. You'll find it there. But we discussed in great detail how tariffs work. We had more fun than a human being should be allowed to have when talking about tariffs. And we explained why, in general, tariffs are not inflationary. And we made this video several months ago, and now that is actually apparently turning out to be the case. Inflation has not gone up dramatically despite the tariffs. So that part of the equation seems to be holding. However, we don't know. It may be that it takes time to filter through the economy and have an impact. But so far, inflation's been going down since tariff day, right? So that apparently is holding with what our view is. Now, the other thing, of course, is the Federal Reserve. And what are they going to do about all this? So there's a huge drama going on, if you haven't noticed it, where President Trump is all over the Fed. He's threatening to fire Jerome Powell if he doesn't lower interest rates. But then he says he's not gonna. But then the next day he says he is gonna. So he's like putting a lot of pressure on the Fed to lower interest rates sooner rather than later. So what's our view on that? Well, our view is that the Federal Reserve does not want to be seen as being pushed around by the President of the United States. So they are not going to lower interest rates sooner rather than later. Our view is September at the soonest. And since inflation is coming down, the economy is holding, it may be time for them to start doing that. So from an interest rate environment and what the Fed's doing, it's going to be interesting to watch how it goes. But we think September, maybe November, before they lower interest rates for the first time since the last time they did, which was last year. So overall, it's a very positive picture. The big gorilla in the room, which could cause everything to go sideways or down, should I say, is the auction. We have $9 trillion of our debt coming due for a refinance. And we had a little bit of a scare a few months ago when the government put out an auction basically to borrow money to pay for all of the stuff that we do to continue increasing our national debt. And it didn't sell out as quickly as people thought. And that was kind of a tremor, not an earthquake, but it caused some people to stop and say, maybe the United States is reaching the point where people aren't so willing to lend us money to finance all the stuff that we do. And of course, if they stop doing that, then Katie bar the door. It could be really, really bad. So when these auctions come up here in the next few months to refinance our debt, it's going to be very interesting to see how well received the auctions are. Are foreigners and even domestic buyers going to buy all of our debt, meaning lend us more money and refinance it all? If they don't, or if it doesn't go well, we could see the stock market go way, way down, because that could be terrible news for the economy, for our ability to finance all the stuff that we do, all our Social Security, our Medicare, all those things. We borrow money to pay for it. That's how it works with us, unfortunately. And if we can't borrow more money, we can't pay for it, and that could cause some significant damage to our economy. So we'll have to wait and see. Now, having said all of that, we give it a very low probability. We don't think it's going to be a problem, but it does illustrate why we think it is so important to always have a plan to address if the market goes way, way down. And since we work with people who are over 50, who are retired or retiring soon, and if you're in the 5 years before you retire and the 5 years after you retire, if you're in that decade, we consider that to be the most important decade of your entire financial life. And the reason why we say that is because if you take a large loss, like in 2008, for example, where the market went down 57% from peak to trough, and then it took almost 6 years to get back to even. If you take those kinds of losses, then your ability to retire, your ability to stay retired are significantly negatively impacted. And we don't want that. And in our firm, we have a strategy we call invest and protect. And in fact, it told us to sell in November of 2007, before the stock market crash happened, and told us to stay out actually until June of 2009. So for almost a year and a half there. And so clients that followed our advice did not lose any money during that terrible, terrible stock market crash. So that strategy is still in place to help us to protect our clients from that eventuality to the best that we can. So again, we don't think bad things could happen, but we always believe you plan for the worst, you hope for the best, not the other way around. We think that hoping for the best and not planning for the worst is not a good idea. So thanks for watching. Please watch the video or the podcast rather, on tariffs. I think you'll find it interesting. All of our podcasts, I think, are interesting. 1 million views. Oh my gosh, I'm so flattered by that. Thank you. Make sure you like and subscribe to this one. Tell your friends, share it with them. And thank you for watching again. And hope it did find you, in fact, healthy, wealthy, and wise. And we'll talk soon.
Retirement Planners of America.